Can leveraged and inverse ETFs calm your investment jitters? A nervous investor's guide to hedging strategies here. The market dances between exuberant highs and nervous lows, and every dip can feel like a personal earthquake for the risk-averse investor. While chasing returns holds undeniable allure, so does safeguarding your hard-earned assets. So, how can you find a precarious balance between growth and protection? Enter the intriguing world of leveraged and inverse ETFs, instruments designed to amplify or reverse market movements. But before you dive headfirst, let's navigate this complex terrain through a series of questions and answers, specifically tailored for the nervous investor. So, what exactly are leveraged and inverse ETFs? Think of them as tools that turbocharge or flip the script on market movements. Leveraged ETFs aim to magnify returns, aiming for double or even triple the daily performance of an underlying index or asset. Conversely, inverse ETFs seek to deliver the opposite performance, essentially betting against the market. Essentially, they're like amplified mirrors reflecting the market's movements, but with their own twist. Sounds enticing, but can't this turbocharging backfire? Absolutely. Leverage magnifies both gains and losses. A 10% uptick in the market becomes a 20% gain for a 2x leveraged ETF, but a 10% dip translates to a 20% loss. Inverse ETFs amplify losses even further, creating potential for significant erosion of your investment. Remember, these tools are like high-octane fuel, powerful, but demanding careful handling. Okay, then these are tools for reckless gamblers, right? Not necessarily. Used strategically, they can play a valuable role in your portfolio, particularly for nervous investors. Here's how. Hedging. Let's say you hold a significant position in the SP 500 and fear a correction. You could buy a small amount of a short-term, ideally daily, inverse SP 500 ETF. If the market falls as expected, the inverse ETF's gains would partially offset your losses, cushioning the blow. Think of it as a safety net during turbulent times. Short-term tactical bets. If you have a strong conviction about a short-term market movement, leveraged or inverse ETFs can magnify your potential gains. But remember, this is akin to playing with fire. Short-term volatility can quickly amplify losses too. Only consider such tactics with significant market conviction and a robust risk management strategy. Market access and efficiency. For nervous investors looking to access specific sectors or asset classes they might find intimidating, leveraged ETFs can offer efficient exposure. For example, a nervous investor in the tech sector could choose a 2x Nasdaq ETF for greater exposure than directly buying tech stocks. However, always prioritize understanding the underlying assets and associated risks before such ventures. Wait, I'm still nervous. What are the risks? Understandably. Here's a rundown of the potential pitfalls. Compounded volatility. Remember the magnifying effect. It works both ways. Even small market fluctuations can be significantly amplified in leveraged and inverse ETFs, leading to unexpected swings in your investment value. Cost drag. These ETFs incur additional fees to maintain their leverage or inverse performance. These fees can eat into your long-term returns, even negating potential gains. Decay and tracking error, daily rebalancing and compounding effects can cause leverage and inverse ETFs to deviate from their intended performance over time. This means their returns might not perfectly mirror the underlying asset, potentially diluting your expected outcomes. Liquidity woes. Less popular leveraged and inverse ETFs might have lower trading volumes, making it difficult to buy or sell at fair prices during volatile markets, potentially amplifying your losses further. Okay, convinced these aren't magic spells. How do I use them responsibly? Start small. Treat them like potent spices, not the main course. Allocate a small portion of your portfolio, think 5 to 10%, to these strategies, never as your core investment approach. Short-term horizon. Remember, volatility compounds. These are tools for short-term market movements, not long-term buy and hold strategies. Monitor your positions closely and exit promptly when your target is reached or market conditions change. Know the underlying assets. Don't just chase leverage or inverse returns blindly. Understand the underlying index or asset class, its historical performance, and associated risks, before taking any positions. Manage costs. Choose ETFs with low expense ratios to minimize the drag on your returns. Seek professional advice. If you're unsure about navigating this complex terrain, consider consulting a financial advisor who can tailor a strategy aligned with your risk tolerance and goals. But wait, are there alternatives to leveraged and inverse ETFs for nervous investors? Absolutely. While these tools can play a strategic role, they're not the only options for mitigating anxiety in your portfolio. Here are some alternatives to consider. Diversification, the golden rule of risk management. Spread your investments across different asset classes, sectors, and geographic regions. This reduces your exposure to any single market swing and smooths out overall portfolio volatility. Focus on dividend-paying stocks. Steady income can be a soothing balm for nervous investors. Consider incorporating companies with reliable dividend histories into your portfolio. The regular cash flow can offset potential losses and provide a sense of stability. Low volatility funds. These funds actively select stocks with historically lower price fluctuations. While returns might be slower, the steadier ride can ease your investment jitters. Target date funds. These one-stop-shop funds automatically adjust their asset allocation based on your target retirement date, gradually shifting towards less volatile assets as you age. This set-and-forget approach can simplify your investing journey and reduce anxiety. Cash cushion. Maintain a readily accessible emergency fund to cover unexpected expenses. Knowing you have a financial safety net can alleviate anxieties about potential market downturns. Okay, I'm feeling slightly calmer. Should I completely avoid leveraged and inverse ETFs then? Not necessarily. As with any financial tool, their suitability depends on your individual circumstances, risk tolerance, and investment goals. They can be powerful tools for experienced investors, with specific market views and a robust risk management strategy. However, for nervous investors, the potential pitfalls far outweigh the potential benefits in most cases. Focus on building a diversified, low-cost portfolio aligned with your risk tolerance and investment objectives. If you still feel tempted by the amplified returns or hedging potential, consider consulting a financial advisor to explore these strategies within the context of your overall financial plan. Remember, the key to calming your investment jitters is understanding your own risk tolerance, building a well-diversified portfolio, and seeking professional guidance when needed. Don't let the allure of quick gains or flashy tools cloud your judgment. Prioritize long-term stability and growth while keeping your nerves in check. By staying informed, making informed decisions, and focusing on long-term goals, you can navigate the market with confidence, even as a nervous investor.